Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst. Today we are going to talk about one of the most dangerous behavioral traps in investing: anchoring bias. This is the invisible mental trap that makes Indian investors buy too high and sell too low. Let's understand how it works and how to defeat it. What exactly is anchoring bias? It's a cognitive phenomenon discovered by Nobel Prize winners Daniel Kahneman and Amos Tversky in 1974. When we face uncertain situations, our brain latches onto the first piece of information it encounters. This becomes our anchor. In investing, that anchor is usually a past stock price, and it silently controls all our subsequent decisions. Even completely random numbers have been proven to influence our estimates. This is not a small effect. It is one of the most powerful biases in human psychology. There are four main types of anchoring that destroy wealth in the stock market. First, price anchoring. When you judge a stock as expensive simply because it was cheaper in the past. Second, 52-week high or low anchoring. When you refuse to buy a stock near its highs, thinking it must come down. Third, purchase price anchoring. When your buy price becomes the reference for all decisions, regardless of fundamentals. And fourth, analyst target anchoring. When you hold or sell based on an outdated broker target price. Each of these is a trap that disconnects you from reality. Let me show you a real example. Look at Titan Biotech, BSE code 524717. Currently trading at 480 rupees. Up nearly 5% today. Market cap of approximately 397 crore rupees. The 52-week low is just 74 rupees 73 paise. That means someone who bought at the low has earned over 540% returns. But here's the anchoring trap. An investor who first saw Titan Biotech at 100 rupees and didn't buy, now keeps thinking every higher price is too expensive. At 200, too expensive. At 300, too expensive. At 480, definitely too expensive. Meanwhile, the ROAS is 16.72%. ROE is 12.74%. And promoter holding is a healthy 55.78%. The fundamentals support the price. But anchoring prevents the investor from seeing this. Anchoring bias is especially dangerous in India for several reasons. First, India has produced some of the greatest wealth-creating stocks in history. Asian Paints, Bajaj Finance, HDFC Bank. And at every stage, investors sold too early because they anchored to past prices. Second, Indian retail investors are notorious for anchoring to IPO prices, which are set by investment bankers, not by fundamental value. Third, we obsess over round numbers like Sensex at 75,000. These are meaningless psychological anchors. And remember, SEBI's own study found that 9 out of 10 individual F&O traders lose money. Much of this is because of anchoring. Traders refuse to cut losses because they're anchored to their entry price. This is why F&O is essentially gambling. Focus on quality stock picking instead. The science behind anchoring is fascinating. In Kahneman's famous experiment, they spun a wheel that landed on either 10 or 65. A completely random number. Then they asked people to estimate the percentage of African countries in the United Nations. People who saw 10 on the wheel guessed around 25%. People who saw 65 guessed around 45%. A totally random number shifted their estimates by 20 percentage points. Now imagine how powerfully a real number, like a stock's previous trading price, influences your perception of value. The effect is enormous, and even professional fund managers with decades of experience fall prey to this bias. The greatest investors in history have found ways to defeat anchoring. Warren Buffett's famous quote, "Price is what you pay, value is what you get," is actually a profound anti-anchoring philosophy. When he bought Coca-Cola in 1988, the stock had already risen significantly. Most investors were anchored to the lower prices. But Buffett analyzed the business value and concluded it was still undervalued. He made billions from that investment. Similarly, the legendary Rakesh Jhunjhunwala was known for buying stocks that others considered expensive. He bought Titan Company when many thought it was overpriced. His focus was always on business value, never on price history. Here are 5 battle-tested strategies to defeat anchoring bias. Strategy 1. Always start with intrinsic value, never with price. Estimate what a business is worth before checking its market price. Strategy 2. Use multiple valuation methods, DCF, relative valuation, and asset-based approaches. If all 3 agree, you can be more confident. Strategy 3. Practice, consider the opposite, thinking. When you think a stock is too expensive because it was cheaper before, ask yourself, what if the old price was too cheap? Strategy 4. Write down your investment thesis before buying, with specific criteria for selling. Strategy 5. Review your portfolio by fundamentals, not by profit and loss. Ask, would I buy this stock today at this price? Here's your action plan starting today. First, never say a stock is cheap or expensive based on where it used to trade. A stock's value depends on its future cash flows, not its price history. Second, build your knowledge systematically. Check out our free value investing course on YouTube. The link is in the description. Third, always remember SEBI's warning. 9 out of 10 F&O traders lose money. The path to wealth is through disciplined value investing in quality companies, not speculation. And join our Telegram channel at Long Term Equity Y for daily value investing lessons delivered straight to your phone. Let me leave you with the most important takeaway. The stock market does not care what price you paid. It does not care what price the stock used to be. It only cares about the future cash flows of the business. Once you truly internalize this truth, you have broken free from the invisible chains of anchoring bias. Thank you for watching. Please like, subscribe, and share this video with every investor you know. Visit multibaggershares.com for more value investing education. See you in the next video.